This particular course is going to emphasize the preparation we're making in for 2014 in small group. As we so often say in our programs, all of this material is dated. It keeps changing both at the state and federal level. So recognize that this recording was based on information around March 1st, 2013. There is bound to be changes since then. We expect a large number of changes in small group and large group in both state and federal around October 1st. So we can assume we'll probably have another one of these courses talking about this type of program mid to late summer. But what will small group look like in 2014? Because that's very important to most of the brokers in Ward and Brown, and frankly most brokers in the state, since the majority of our California businesses are small group. What we need to recognize is that a Assembly Bill 1083 was passed in the fall of 2012. And that was basically a substitute bill for what used to be called AB 1672. Those of you who've been around a while know that 1672 has been changed, modified, updated, edited for a series of bills over the years. But nonetheless, we continue to think of ourselves as being regulated from the selling side for small group and individual by AB 1672. Well, AB 1083 will be the new one, except we have a special session of our state legislature, in fact 2 of them going on in this exact moment, and they are rewriting 1083 even as we speak. The reason for this is AB 1083 was written in light of what was known about PPACA in the fall of 2012. And no sooner had the bill been signed into law by the governor than things started to change with various rulings that came out of the federal government, and our state assembly is trying to keep up with those changes. So we're going to have to see what particular changes are made with our special session. In fact, by the time you're watching this recording, some of those changes may already be in play. And the principal changes have to do with conflicts between AB 1083 and PPACA, as an example. AB 1083 talked about 18 different geographical rating areas for the state of California. But a PPACA ruling coming out after the law was passed said that a state can have no more than 7 rating regions. Well, for a small state like Connecticut or Rhode Island, 7 may work, but you can imagine a state like California, the size of the 5th country in the world, 7 rating areas would be a problem. So what's going to happen if our Assembly Bill 1083 or a special session bill stays in conflict with PPACA? Well, there will obviously be some negotiation between our state and the federal government, and special safe harbors may occur, or somebody will have to make some changes. But we'll talk about those as they go along as we continue to train later in the year. What we really want to start with, though, is some updates that occurred after 1083. And these updates are going to seem problematic to many of you who are watching this webinar, because they don't make sense with the way we do business in California. But we're going to have to accept them for what they are and determine at a later date whether the state makes other changes or whether PPACA backs down on some of these descriptors I'm now giving you. And it starts with enrollment. The federal regulatory bodies, the IRS in particular, have come out with new definitions of enrollment. To start with, how are we going to define enrollment periods? Well, PPACA is going to say that there is an open enrollment period for small groups that is going to be dated between the 11/15 and 12/15 each year. What's not clear is whether those will be for December 1st effectives or January 1st effectives or February 1st effectives. But there's going to be a defined open enrollment period. And if you use your logic, you can recognize that, well, there's an open enrollment period, 11/15 and 12/15. That means there's some other kind of enrollment period for the rest of the year. We'll get back to that. This other enrollment period we could simply call outside of open enrollment. We might not care, except the problem is the rules change between open enrollment, that 1 month, and outside open enrollment. We also want to recognize that PPACA describes special enrollment. The way to think about special enrollment in PPACA is think life changes or COBRA-like event. It doesn't have to be COBRA-like, a COBRA-specific. For example, you could have an exchange doing individual enrollment where somebody refuses to join the exchange because they're employed and covered with their employer. But then 8 months later they lose their job. Well, this would be the special open enrollment for that person. It's a COBRA-like event. And they would be allowed to come back into the exchange at that time. So we're going to describe this open enrollment, outside enrollment, and special enrollment for you. This will be for effective plan years 1/1/2014. The rules I'm describing, in theory, could cease at the end of 2014. The IRS is simply telling us they're good for that period of time. We do believe they'll probably be extended a bit, maybe to a second year, but sometime in the future these rules could be changed. So what are the rules for 2014, starting 1/1/2014? Well, it begins with underwriting requirements. In an open enrollment, 11/15 to 12/15, a carrier will have restrictions on his ability to enforce participation and contribution requirements. Specifically, a small group coming into the shop or coming into the open market carriers cannot be denied coverage for failure to meet participation and contribution requirements. Or in other words, you have a 45 life group and only 5 people are going to take the coverage. They apply for that coverage during the open enrollment period. They must be accepted. Participation and contribution cannot be used as a reason for denying them coverage. I'm certain someone listening to me probably thinks I've either lost my mind or have misstated, but that is the new set of rules, even though it flies completely in the face of all California regulation and even common sense and risk analysis. That is the open enrollment rule. Now, outside of the open enrollment period, a small group or an individual can be denied. Outside the period, they can be denied entrance until the next open enrollment period. What that simply means for us in small group is it's business as usual for all enrollment periods except for 11/15 to 12/15 each year. Now here's where it's really weird. PPACA then turns around and says that while a small group cannot be denied its policy during open enrollment, participation and contribution can be used to drop the group at renewal. So a group can come in 1 year with 5 out of 25 people applying and be dropped at the next open enrollment. The IRS obviously has had a lot of phone reaction to this, and they're involved with discussions with the carriers, and we don't have a resolution yet as to how we're going to actually manage our business. So at this stage, we're assuming that small groups failing to meet participation contribution need only wait till 11/15 to 12/15, and they can get their coverage at least for a year. What other kinds of rules are involved? Well, it has to do with special open enrollment. In other words, somebody loses their coverage. Somebody has a baby. They have a divorce. They move out of an area for an HMO and move into a new HMO area. They get married. Any of these special open enrollment periods would normally create an opportunity to make a change in small group, these COBRA types of events. Inside small group and large group, we continue to have the same kind of rules for these special open enrollment periods. An individual, however, working with the exchange would have 60 days to go back to the exchange in an attempt to get coverage. So while we would have a 30-day notification rule in group, individuals will have a 60-day notification rule for the exchange. You may say, well, what do I care? The exchange open enrollment period is October 1st through the month of January. If someone does not enroll during that time and then later gets sick and on the way to the hospital they think they can enroll in the exchange, they're going to discover they can't. However, if someone did not take coverage because they were working, they were in a small group and the small group went out of business and now it's April 1st, that individual could enter into the exchange at that time based upon the 60-day limit. So special open enrollment periods for individuals will be with the exchange, group-based will be within 30 days. However, keep in mind that at this point, the shop is saying for small groups that while they are now 60 days, they will convert to the 30-day program. That's for small group in the shops. As I said, 1083 is the next AB 1672, and special sessions may change such things. Here's some changes that will occur. There's two changes in particular for small group. First, January 1st, 2014, small group will be defined as 1 to 50 lives. Full-time lives will be 30 hours per week. When I say one life, I do not mean the one life group that we get under 1672 when you have, for example, a 5-life group with 4 of the people with proper waivers. They're covered by their spouse. Then a 1-life group could come in under that situation. We are talking about a 1-life sole proprietor group being identified as small group. Secondarily, we have a typo I see on this particular slide. Must be using the wrong one. January 1st, 2016, small group will go from 1 to 100. Again, that's January 1st, 2016, 1 to 100. Now, please keep in mind, discussions about PPACA being small group or large group in terms of being required to provide coverage have nothing to do with Assembly Bill 1083. 1083 is simply saying that in California, for the purposes of selling, we will treat a 50 to 100 life group as small group. That doesn't mean they're called small group for PPACA penalties. Anybody over 50 plus is a large group for penalties, and PPACA will stay that way. What this simply means is a mid-sized group of, say, 75 lives right now that could be denied the opportunity to get quotes from every carrier, because a carrier is not required to quote them today. Come January 1st, 2016, a 75 life group will get his quote the same way small group does. Everybody will quote. It'll be basically a spreadsheet or website type of quote, probably operated through a quote-o-matic, such as with Gordon Brown, that kind of thing. Will also go into the exchange that way. So what are the reasonable proofs to prove group size, particularly when it refers to 1 to 50 come 2014? A 1-life group will be consistent with what's known as PPACA Section 1304. If you want to go to the 2,300 pages of PPACA and read through Section 1304, but we'll give you the shortened version here. It'll probably be good enough for you. Sole proprietors are considered obviously 1 life. S corps of 1 life will be included. Basically, Section 1304 describes an individual actively engaged in business or service, no matter how he may be organized, whether sole proprietor, S corp, or whatever. Actively engaged in business or service would be the example. For example, I live in the city of Orange, California. I have residual income from health insurance policies that I sold when I had my own agency. Those checks come to a mailbox in a post office in the city of Orange, California. And even though I'm no longer doing retail activity, because I get those commission checks in a residual form, I'm declared to be actively engaged in business by the city of Orange, and they send me a tax bill every year that I have to buy a business license, even though the only business I'm doing is going to the mailbox, opening it up, and depositing my checks in the bank. Well, that's enough of business activity for the city of Orange to want me to be licensed. In this particular case, that requirement for a license would demonstrate active engagement in business or service, and I could use that to guarantee myself a small group product under California law. The company size can be tested annually before each renewal to determine whether it's small group. Now, one may wonder, why would I as an individual want the small group product? Why don't I just go to the exchange and get an individual policy? Well, it depends upon the benefit designs and the pricing. I may find it more convenient to buy a one group life, small group life health insurance policy rather than buying the individual policy from the exchange or on the open market. Wherever my best deal may be is where I'm going to go. Now, obviously, when we count group sizes for PPACA and for these rules, we're going to have to deal with issues of common ownership. A lot of brokers are out there thinking that companies can simply take their different divisions, divide them up into different tax IDs, and get out from being a large group or become a small group or whatever it may be. Well, PPACA and state law is pretty clear on companies with common ownership. First off, if I am a franchise, I own 5 McDonald's in town. Each of my 5 McDonald's has 20 employees. I'm a 100-life company. Even if I give those companies off to my brothers and sisters and sons and daughters and file them under different federal tax ID numbers, I'm still going to have to wrestle with the issue of common ownership. The first question that's going to be asked of me is, am I eligible to file a combined state tax return? I don't have to actually file one. I only have to be eligible to file one. Now, Ward & Brown is not a CPA. You need to talk with the CPA to determine whether your collection of companies are eligible to file a combined state tax return. But if that CPA comes back and says, as you're organized, you're eligible even though you don't do it, then all the people in all those separate companies get counted together under common ownership. These tests are an either or. You can meet any of these tests of common ownership and end up being declared a common company. What's the second test? Common control. Obviously, common control, you can look at the IRS codes 414 B, C, M, and O. But basically what they're saying is common control is related ownership. So a firm with 5 or fewer owners collectively owning 80% or collectively owning them through family members would be considered a common company. Spouses, children are generally considered one owner. Somebody always asks a cute question such as, well, what if my daughter got married? Could I give it to my son-in-law? If they're still married, that's common control. Now, if it's an ex-son-in-law and he's divorced and you want to give him one of your companies, that's fine. It's not common control, but probably not a very good idea either. What else have we got for common ownership? Well, let's use some examples. Let's assume there's an auto shop that is owned by 2 fellows, John Doe and Jim Smith. They own 90% of the auto shop. 10% of it's owned by someone else who gave them a starting bit of capital when they first started. In this case, the two are split the 90% ownership, 45 each. Now let's also assume they own a tire store. They own 50% of the tire store. A different third party owns the other 50%, and they split their 25. Well, if you think back to that last slide, 80% was the threshold level in this example. And of course, do we have a common ownership? The answer is no, because together they don't own 80% or more of the second company. So, if the auto repair had 25 people and the tire store had 30 people, each company would be counted separately for PPACA and state purposes. Each would be declared to be a small group because it's under 50. Let's look at a different kind of a company, though. Here we have Mark Brown. He owns 90% of Brown's Taco, and he has 53 employees. He's a former partner who holds the remaining 10%. Across the street, he has his good friend George Johnson, who owns 80% of GJ Lunchtime, with 37 employees, and a different partner who owns 20%. Well, Mark Brown suddenly realized what a great idea it could be if he could shift some of his management, perhaps, over to George Johnson's payroll, pay George for it, and better yet, go ahead and trade some value in each other's company to try to get the 53 and 37, which is a total of 80, into 2 companies of 40 each, being below the PPACA threshold. So they go ahead and do a sale to each other so that each owns 45 and 40 of the other. They then move the companies between each other so that each has 40 employees on their respective D9C, and they think they beat the tax man, so to speak. Problem is, this is a common group. Yes, it is, because together they own 80% in both of the firms. Point of fact, this is an 80-life group. I'm sorry, 90-life group. Yeah, I mean 90-life. And this is a 90-life group, and in this particular case, George Johnson's gotten penalized because originally he would not have been involved in the company at all. What other things are going to change in 2014 besides group size? And you're going to have to understand your common ownership to determine group size. Well, how we're going to process small groups, quote information, and the submission of cases is going to change. First off, carriers are going to be restricted from asking or attempting to retrieve certain types of information because medical conditions, all pre-X must be met, and medical conditions cannot be used to determine a rate in California after 2014. Therefore, eligible employees or dependents are not required to fill out a health assessment or medical questionnaire prior to enrollment. It's still possible the carrier may come back and ask for that information after the case has been issued in order to get a demographic database, in order to understand what health conditions they're inheriting, perhaps for continuation of care issues. But it cannot be used prior to issuance. What else? Second rule on health information is that a health plan shall not acquire or request information that relates to health status factor from an applicant or his or her dependent or any other source prior to enrollment. In other words, a carrier can't go out and do a medical information bureau record check prior to issuing the case. Other kinds of changes that occur in small group for 2014 is how we're going to define that an offer has been made. As you know, right now, offers get hung up for missing pieces of information. Sometimes the information may be of a quibbling nature. Sometimes it's a lack of a signature on an employee app, whatever it may be. This is going to become much more simplified. Ultimately, all the apps are going to have to be completed and signed, but that will not be the basis for holding up the issuance of a case. Paperwork is submitted. Health information is not needed at the time of submission. And a health plan has 30 days to notify the employer on the offer of coverage and the total premium. We're going to find out that you may not have an exact quote in the way we had in 2013 because of some changes in the way rates are going to be done. But for the moment, let's assume that a client has reviewed his options, has filled in the master app and has done the majority of the employee apps, and has submitted a check for perhaps 70% of the premium. The carrier has 30 days to notify the employer that he owes a 30% more on the premium, whatever other information is going to be needed to determine if he is actually a group, but that's the only holdup. The employer then has 30 days to accept or refuse the offer. The acceptance or refusal of the offer is determined by sending a check for the full amount that has been quoted by the carrier. The example I just gave you, he sent in a 70% check at the start, so he returns the 30%. That check is indicative of accepting the offer, and the case has to go ahead and be processed. The effective dates is based upon when the check is postmarked. So a check postmarked between the 1st and the 15th of the month will become effective the 1st of the next month. I get the letter from the carrier saying I owe 30% more. I postmark the check by the 14th. I'm effective the 1st of the month. A small group is. A check postmarked between the 16th and the end of the month will be effective the following month, 1st of the month. Premium calculations are going to be very different and somewhat more complicated. First off, no risk adjustment factors can be used. So a health condition, group size, whatever it may be, no risk adjustment factor. This may explain to you why a number of carriers are suggesting to some small groups that they renew early, because a renewal in December of 2013 still would have a risk adjustment factor, and they would be able to carry that risk adjustment factor, hence probably a lower rate through the year. While I'm talking about that, I want to go sidetrack for just a moment. Keep in mind that the process of renewing early does not void anybody's PPACA penalties. First off, the carriers are very specific. They're talking about groups renewing who are small group, and small group are not eligible for penalties, therefore it wouldn't make any difference. But if you had a group masquerading as a small group, you have an 80-life group, somehow or another a carve-out of 20 people have been done, and the existing carrier doesn't even know the other 60 people exist. Changing to a December 2013 renewal does not mean you are going to avoid the PPACA penalties starting 1/1/2014. The only way you avoid PPACA penalties on 1/1/2014, if you are a large group, is if you renew on your regular renewal date for 2014. In other words, your regular renewal date was 2/1/2014, then 2/1/2013, then your renewal date would be 2/1/2014. If you are covering at least a third of your employees and you are renewing on your regular date, then your penalties would not start to accrue until 2/1/2014. The same would be true of someone renewing 6/1/2014, etc. At this point, given that we're recording this on March 1st, 2013, everyone is stuck with whatever their last renewal day of the year was. So if you renewed on 11/1/2012, your renewal date will be 11/1/2013, and your renewal date when penalties would start would be 11/1/2014. So keep that in mind when we talk about these early renewals. The early renewals are for legitimate small groups to avoid the changes we're talking about in the next few slides. And one of those changes is going to be risk adjustment factors. They go away. At the moment, we're talking about 19 geographical areas being defined by county. That may change both due to the general session and due to PPACA. Family composite will be single, two-party family. The plan design will obviously make a difference on how much you get charged, and there'll be no less than a 12-month rate guarantee. What will be the age bands? Well, age will be calculated at the time of policy issuance or renewal, and that's where you may find a change in the premium from the day you quote it to the day it gets issued, because new hires will be at the time of enrollment, rather obviously. The age bands will be all children priced the same, 0 through 20. 2-year-old, 3-year-old, 4-year-old, 5-year-old, 20-year-old, all the same rate. Secondly, there'll be 1-year age bands, 21 through 63, and that's the problem in terms of age calculation for the policy at the date of issuance. Let me explain. Let's assume we have a small group of 24 people. Like most brokers, you run a quote 60 to 90 days in advance of enrollment. On average, with 24 people, 2 people will be changing a birthday every month. So if you ran that quote 90 days in advance, 6 people have turned a new age by the time of enrollment. And the rate being quoted at the time of enrollment will be on that person's 1-year band. Now, carriers may say that I'm going to have the same rate for ages 21, 22, 23, 24, 25. And then they could change them for age 26, 27, 28, change them again on 29. The law allows the carrier to change the rate every year, which means you need to make the client aware that whatever quotes you gave for the employees prior to enrollment, that date of enrollment, whatever age that is, that's where the rate will be. So there could be some changes. You'll note also it talks about through age 63, meaning at age 64, new rules apply. You'll also note that it talks about no more than a 3-to-1 ratio. What that's referring to is this. Take age 21, whatever rate is being charged, age 63 can only be 3 times more than that. So if a 21-year-old is being charged $100, the maximum a 63-year-old can be charged is $300. How much can a 0 through 20 child? Actuarially, whatever the rate is, they all get the same rate. If you have a family rate, they're going to charge you for three of those children. So it doesn't really matter whether you take the youngest ones or the oldest children. People always ask, what about a dependent child age 26 who comes back onto his policy? Is he in the child band? No, he's in the 1-year band for a 26-year-old, and that's what would get charged. When you get up to 64 or older, all one price. If you're thinking this through, you suddenly realize then that Medicare, primary and secondary and small group no longer applies. All one rate, 64 up. You might also recognize that while a 2-year-old and an 8-year-old may not be much of a difference in terms of actuarial rate, a 64-year-old who's still working and a 72-year-old student who's still working is going to be a huge age difference. Basically, all going to be one price. Rather obviously, we're going to expect to see some fairly significant increases in the senior 64-plus rates. Do the 64-plus have to be inside that 3-to-1 ratio? Absolutely not. Only 21 through 63. The county list, as you can see, will literally be by the counties listed. I recognize these slides are going rather quickly for someone trying to read through, so I'd recommend that you go to wardenbrown.com and find the list of the AB 1083 county lists if you're interested. You can also find them posted on coveredcod.com, and you may find that they're being changed due to the special sessions that I talked about earlier. As you can see, some counties are grouped together. Big counties such as Alameda, Santa Clara, San Francisco, each have their unique cost structures. In the areas of Los Angeles, they can split counties as long as we have no more than 19. Now, there have been changes in the rules about broker disclosure requirements. Some of these differences may not seem like differences to you if you are familiar with the disclosure requirements under AB 1672. However, to reinforce, AB 1672 and 1083, when you are making no specific recommendation, you're doing your first call or you're just gathering data, or you're talking about a market survey where you're talking about all the plans that are available. At that time, you are obligated under old law, new law, to say that any health plan is obligated to sell its product to the small group. Upon request, the carrier has to provide the rates and has to provide the benefits. Of course, they provide the rates and benefits through the GA or through the broker. And you also have to notify the small employer that certain tax credits are available and whatever the guidance may be in line at that particular time. The tax credits they're talking about are the small group tax credits that typically apply for a group of 25 or less with an average payroll of $50,000 or less, but again, to maximize the tax credit benefits, it's for groups of 10 or less or 25,000 or less, and usually that small group doesn't carry health insurance. Go to the Ward & Brown website for more information about those small group tax credits. Secondly, when making a specific recommendation, you are obligated to provide a benefit summary and the premium for each of the plans of that carrier. What that means is, I'm not required to show every carrier, Blue Cross Blue Shield, Health Net, Kaiser, etc. But if I show one Blue Cross plan, I'm obligated to show every Blue Cross plan and all the premiums. Now, when I show, I simply mean I have to take out a summary quote, a quote-matic from Ward & Brown as an example, and deliver it. That fulfills the obligation. You also have to notify the small employer that if he wants an evidence of coverage brochure for any of the plans, that they will be provided upon request. And this part's new. You're going to have a signed statement from the employer acknowledging that you have made him aware of the two things we've just been talking about. No doubt the state of California will provide us a template which we'll get onto the Ward and Brown website. But when that template comes about, you'll just carry them around, very similar to what occurs with a loan officer if you've ever taken a bank loan out. You have all those documents to sign stating that he's explained all your rights and privileges to you. It's the same basic deal. Affirmative marketing requires that all carriers will make all benefit material available to brokers, agents, consumers, whoever it may be, and that these rules about selling these types of policies must start October 1st, 2013, with the exception that if a carrier is offering something through the exchange on that date, he will have deemed to be in compliance with that starting date for all this open market material. So a carrier can arrange not to fulfill any of these requirements till 1/1/2014 if he has a plan inside the exchange. Most of our carriers are already meeting these requirements to start with, except for the signed statement acknowledging that the rights have been discussed. So what do we got going for 2014? We have our small group definitions. They will be obviously 1 to 50, and then in 2016, 1 to 100. We have no pre-existing conditions and no RAF. That will obviously be affecting the rates for both good and for bad. Will have some effect after 2016 or 50-plus groups because they'll be able to get those small group types of rate bands. Premiums are obviously going to go up differently for different age groups. Given that we have a 3-to-1 ratio, it's unlikely that we're going to have the 64-year-old rates come down. It's more likely the 20-year-old rates will go up in order to maintain that 3-to-1 ratio. And of course, stay aware of the broker disclosure requirements as we go along. The next program we're going to look at what's going to be happening in large group, and we hope you'll be in attendance for that program.